Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we've just published our latest forecast for July 2021, and they're showing a much better economy in a sense, a very strong, in fact probably too strong economy, rising concerns though around pricing pressures and also what comes next, because if we've dragged so much money from the future into now, what does that leave us with in a few years' time?
Yeah, it's fascinating looking at household spending. Growth there expected to get up to over 10% this year. Now that's a little bit inflated because we had the lockdown last year, which was a hole in spending. But if you look at how spending has gone since December 2019, it's up about 6.5% over that 5-quarter period. Now that's the sort of growth rate we'd be happy with in normal times, or we'd be ecstatic with actually. So we've had a pandemic, and yet we're still growing, faster than we would normally. You put that. You look at what's been going on in terms of very low interest rates. So that's put a lot more money into households' back pockets, or at least mortgage holders' back pockets. The government, with its $62 billion COVID fund, now they've reportedly only got $5 billion of that left. It's interesting when you look back at July last year and the government said, we're going to keep $14 billion in reserve. Well, they haven't. They continue to spend it. I know we've had some lockdowns in Auckland and more recently in Wellington, which have meant there has been more support going out in terms of the wage subsidy, but it hasn't been $9 billion worth, nowhere near it. So they are, the government in particular, continuing to stimulate the economy like it needs support. Seriously, this economy does not need any more sort of spending coming out from the government in that regard. I know there's still a bit of pain in some of the tourism areas, and I'm not glossing over that, but by and large, this economy really is on a track for overheating. As you said, if we're growing so fast at the moment, what does it mean over the medium term? Well, basically, if we start to put up interest rates, if we start to cut back on government spending, the ability for the economy to grow over the next 3 or 4 years then becomes that much more difficult. We've done all our growing, we've brought it forward out of future years, and I think we are in potentially for a period of slower growth, particularly given some of the pricing pressures and inflationary pressures we're seeing now that mean the Reserve Bank are probably going to have to tighten monetary policy, lift interest rates more rapidly than anyone would have thought 6 or 12 months ago, and that is going to impact on households' ability to keep on spending.
I mean, part of this is sort of a good problem to have more than what we previously had. We were expecting doom and gloom for the economy last year. So this is almost lesser of two evils, but also in a sense exactly what we've been asking for. We've been printing enormous amounts of cheap money. We've been throwing anything we can out the door to keep things going. I mean, in a sense, it probably shouldn't be as surprising as it might appear. But I think you're also right when you sort of talk of, because we've dragged that future growth into the here and now, it sort of says, well, if you want to actually achieve better growth as we move forward, you've got to find something different to do it. It's not just going to be that money that's essentially no longer available. We've spent it. It can't be spent again. You can't have that level of government investment or similar. And in actual fact, because of the heat of the economy, the Reserve Bank's going to have to try and take a little bit of oxygen out of the fire. It suggests that, again, this real important focus on productivity is going to be critical for the country, because we've got to find a different way of doing things, and it's got to be something that's less cheap cash and much more work smarter, not harder. But as we go ahead, I mean, those pricing pressures are also going to become quite a constraint in terms of, we are seeing for the first time in probably a decade some of the hottest inflationary pressures. I mean, what does that mean for the likes of mortgage borrowers, but also for savers? Because it's obviously, something where we're still going to be seeing stimulatory support, maybe just not as much.
Yeah, for mortgage borrowers, I mean, your 2.2% mortgage rates that you've been enjoying over recent months, they're disappearing rapidly, and you are going to face higher costs over time, of course, because we know that 85% of mortgage lending is on fixed rates. And so it will actually take time to impact, and households will have some time to adapt. And we know also that the banks have been putting in higher test rates when they've been assessing people's ability to service the mortgage. And so, look, I don't think it's going to cause a collapse of the housing market, but it does mean that households will have less money to spend on sort of discretionary stuff. over time. I think the other interesting thing in that inflation area is that if we look in the wake of the GFC, we all expected more inflation as a result of the money printing and quantitative easing that went on there, not in New Zealand, but certainly around much of the rest of the world. We didn't get it, I think, because China was continuing to drive down prices with their economies of scale and increase production. It's less guaranteed, I think, that that's going to rescue the global economy this time around. And so we could be facing, a more sustained period of higher price pressures as well. You also ask about savers. Yeah, okay, you're going to be getting a better interest rate as those term deposit rates rise at the bank. But the problem is, of course, you pay tax on that, so you lose maybe a third of it along the way. And those interest rates are still going to be below how fast prices are rising. So you're actually losing money effectively, or losing spending power. So while it might seem like good news for savers at face value, it's not really. Inflation is ultimately the sort of a big evil for savers, and really erodes their the savings that they've got. So it's not a good position to be in. You say it's better than the alternative, and that is true. But I think the key for New Zealand is, what does our potential growth look like over the medium term? I don't see it as being particularly positive. The government has grand ideas or grand hopes for how we can improve productivity, putting up the minimum wage, making us our businesses invest more in a capital, plant and machinery. That means we aren't reliant so much on workers, but that's a long, slow process. And indeed, New Zealand businesses, being a lot of small and medium enterprises, are probably going to struggle to do that as well for a range of reasons. So I'm concerned just about what growth might look like over the medium term. We've front loaded it all, and now there's maybe not a lot left to do over the next few years.
Absolutely, and I think those are the key messages, right? The economy is in quite a strong position, but sort of an overheating, overextended position at the moment that is going to put pressure on prices, and it's also going to mean that our trend growth as we move ahead could well be lower than we were previously expecting, because we've moved that growth from future years into the here and now, and that doesn't leave as much for the future. We'll continue to assess that, how the economy rolls, and what that future growth outlook might evolve to in one of our future editions of Econ Talks.